In this video, I'm going to cover money market funds, typically for most people, the highest yielding safe cash investment option available to investors. Now, if you have investable cash sitting in a bank account, money market funds are an alternative that you may want to consider, as it provides one of the most competitive yields on cash-like investments and at minimal risk. Now, before we get into that, I'd like to redirect your attention to the balance sheet behind me. Now, these are the assets of Warren Buffett's company, Berkshire Hathaway, and it's notorious that he's been holding a lot of cash. However, Buffett isn't just letting that cash sit in the bank, he's instead investing that cash in short-term treasury bills. Now, part of the reason why Buffett does this is because it's still effectively a risk-free investment, but it provides a much more competitive yield on that cash compared to depositing that cash with banks. Now, this option isn't just limited to large investors like Buffett, but is also available to small retail investors like you and me. You can invest in treasury bills directly through the US government. However, there is an easier way. And that's where we get to money market funds, which investors like you and me can benefit from. Take, for instance, Vanguard's Federal Money Market Fund, which effectively invests cash just like Buffett does within Berkshire Hathaway. The fund invests directly in US government securities, which allow it to pay a higher rate of interest than most bank savings accounts. For instance, the Vanguard Federal Money Market's yield is currently 2.31%, which is higher than what you would get, for instance, in an Ally savings account, which is currently yielding 2%. Now, one can certainly argue that 0.3% or 30 basis points is not going to move the needle a lot when it comes to the actual returns from these cash balances. And for the most part, if you have relatively small cash balances, I'd be inclined to agree with you. However, if you have larger cash balances and want to make sure you're getting the most competitive yield, then money market funds are worth serious consideration compared to alternatives like savings accounts. Now, before investing in a money market fund, it's important that you understand some of the key differences between these funds and regular bank deposits. Effectively, a money market fund is like a mutual fund, but instead of investing in stocks and bonds, it is investing in highly liquid cash-like investments and treasury bills that have a very high credit quality. While this makes these funds extremely low risk and they aim to preserve your principal at $1 per share, they aren't FDIC insured, and on very rare occasions, you can potentially lose money in them, and this is referred to as breaking the buck. For instance, there is one money market fund in 2008 called the Reserve Fund, which had invested in short-term commercial paper or very short duration loans with Lehman Brothers prior to its collapse. Given the losses from those investments, the Reserve Fund actually broke the buck and its share price dropped from the stable $1 to 97 cents. So on very rare and extreme occasions, this can happen, and it's important that you take time to select the money market mutual fund, which you believe will minimize any risk in an extreme scenario by only investing in the highest quality assets. Going back to the Vanguard Federal Money Market Fund, we can take a look at actually what investments are inside this fund to get a better sense of what kind of risk owning this fund entails. In this case, the fund invests primarily in US Treasury bills and US government obligations, with respective portfolio allocations of 53% and 31% each. These are effectively risk-free investments, as it's extremely unlikely that the US government will default on these short-term obligations. This is part of the reason why Warren Buffett feels very comfortable having billions of dollars invested in these treasury bills instead of just holding cash. An additional 16.5% of the fund is invested in what are called repurchase agreements. Effectively, repurchase agreements are short-term collateralized loans. For instance, if another financial institution was holding treasury bills but wanted to have some cash at the time, they could sell these treasury bills to Vanguard in the form of a repurchasing agreement, where Vanguard will agree to buy these treasury bills at a certain price today. The financial institution will have access to this new cash, but then will have to buy back these securities at a later date at a slightly higher price. The difference between what Vanguard paid for these securities and what the financial institution will have to buy them back at later is effectively the return from this repurchase agreement that gets collected by Vanguard and then passed on to you as an investor in the fund. Part of the reason why repurchase agreements are generally low risk is because they're collateralized by these assets. If on the very rare chance that the other party decides to keep the cash and not honor the repurchase agreement by buying back the securities, Vanguard can then sell those securities in the open market to recoup their investment. So overall, if you're looking for a more competitive yield on your cash than you can get in traditional banking deposit accounts, you might want to consider the Vanguard Federal Money Market Fund. Some things to consider is that it does have an initial minimum investment of $3,000 and an expense ratio of 11 basis points. However, the 2.31 yield here is after expenses, so this is what you should expect to earn within this fund. Another potential option which has a slightly higher yield is the Vanguard Prime Money Market Fund, and this is a fund that I personally use for my investable cash assets. What's different about this fund is that instead of investing solely in government securities, this is a retail money market fund, meaning that it can invest in short-term investment securities from the financial industry. These investments allow it to generate a slightly higher yield than the Federal Money Market Fund. In this case, the Prime Money Market Fund earns 2.44%, instead of 2.31%. As mentioned earlier, to achieve this higher rate of return, the fund does invest in assets outside of just US Treasury bills. In this case, 7% of the fund is invested in certificates of deposit or CDs with US banks. And 56% of the assets are short-term Yankee bonds, which are effectively loans from foreign banks that are denominated in US currency. As an example, this could be a short-term loan with an Australian bank or another international bank, but it's denominated in US dollars, so there is no currency risk. Now, Vanguard has a long history of being conservatively managed, but this is an additional extra tail end risk that you might want to consider. Personally, I think it's highly unlikely that these two money market funds will ever break the buck, even during periods of significant financial distress. Both funds were conservatively managed during 2008 and investors incurred no losses. However, again, before investing in a money market fund, you should understand the money market reform that took effect in late 2016. This reform forced all money market funds to be classified as one of three types: either retail, government, or institutional funds. Furthermore, in accordance with SEC rules, both retail and institutional money market funds allow them to impose what are called liquidity fees and temporarily suspend withdrawals known as gates in certain circumstances, particularly in times of significant financial distress. The liquidity fee could theoretically be up to 2% charged by a money market fund for you to sell your shares. This is by no means a normal occurrence and would only occur likely during extreme market duress. The idea behind imposing a liquidity fee during these periods of distress to discourage investors from pulling out all of their money immediately from money market funds. If that occurred during periods of market duress, it could potentially cause and force the money market funds to liquidate and sell assets at below market pricing, which could incur losses for the fund. Again, this would likely only occur if we were to see something like the financial crisis again. In addition, those retail and institutional money market funds have the ability to temporarily suspend or restrict withdrawals for up to 10 days in a 90-day period if their weekly liquid assets drop below 30%. Now, weekly liquid assets is any asset that's maturing within the next 5 days. Now, these liquidity fees and gates are something that you should keep in mind as, again, a tail risk for these funds, but I wouldn't necessarily say that these are exclusive to money market funds and don't exist to any extent with regular bank deposits. In periods of extreme market duress, it's possible that there may be declared bank holidays, which would have the same effect as a gate, as it would make you unable to withdraw your capital during that period of time. In normal day-to-day circumstances, the liquidity for these funds is quite high, and there's no restrictions for how you move money in and out of these funds. Additionally, one other benefit with money market funds is that their returns are closely tied to the federal funds rate. So if the federal funds rate continues to rise, you should expect that the yield of these money market funds will also increase as well. This is different than many bank accounts, which may be slower to raise the interest rate yield on their accounts, even as those federal fund rates continue to rise. Also worth noting is if the federal funds rate declines, the income earned by the money market funds will likely decline as well. During the period from 2009 to 2016, returns on money market funds were effectively zero simply because the federal funds rate was pretty much zero as well. Only now that these rates have risen have these funds become a more attractive investment opportunity. Overall, I hope that provides you some better perspective on money market funds, some of the benefits that come with their higher yield, as well as some of the potential tail end risks. Now I want to hear your thoughts. Do you think it's worth investing in a money market fund, or will you be sticking to FDIC insured accounts? Let me know your thoughts in the comments below, and until next time, thank you so much for watching. My name is Michael, and I will see you in the next video.